Australia's biggest business lender reported a profit drop and a $300 million increase in forward-looking provisions on the same day markets began pricing in a third consecutive rate hike. That combination is not a coincidence, it is a sequence. NABs' half-year result came in at $2.64 billion in cash earnings, below expectations, but the headline miss was almost beside the point. The more significant signal was buried in the credit line, $706 million in impairment charges, up from $485 million in the prior half. The bank explicitly tied $300 million of that increase to potential stress from the Middle East conflict, specifically exposure to sectors where fuel and freight costs are rising fastest. That provision is a forward bet. NAB is not marking losses it has already taken. It is building a buffer for losses it expects, and the size of the buffer tells the market something the rate decision itself does not. The bank's internal model thinks the pressure on Australian borrowers is not yet in the data. The RBA's position makes this harder, not easier. 75% of surveyed economists now expect a 25 basis point hike at Tuesday's meeting, a decision that would take the cash rate back to its 2024 peak. The logic is straightforward. Trimmed mean inflation is at 3.5%, well above the 2.5% target, and the energy shock from the Strait of Hormuz is expected to push Q2 figures higher still. The RBA started hiking before the Middle East conflict. The conflict has not given it a reason to stop. But the economy it is hiking into looks different from the one it began with. Business and consumer confidence have declined sharply. NAB's own CEO flagged that a recession is possible. The dual shock of rate rises and fuel prices is already showing up in like-for-like retail sales. Accent Group reported a 1% contraction in comparable sales as April progressed, even as nominal sales grew 7.1% on new store openings. The gap between those two numbers is the inflation margin doing the work of the top line. If the RBA hikes tomorrow, the cash rate sits at 4.35%. If 52% of the surveyed economists are right, another hike follows in August. The question NAB's provisions are already answering is what happens to borrowers when the cumulative weight of those decisions lands on a business sector that took on 11.5% more debt in the past year. The consumer stress that NAB is provisioning against did not stay theoretical on Monday. Two of the ASX's most watched retail and consumer names provided direct evidence that the squeeze has moved from macro forecast to earnings reality. A2 milk fell as much as 18% before recovering to a 13% decline. The immediate trigger was a voluntary recall of 3 batches of U.S. infant formula after trace levels of cereulide were detected. No illnesses were reported. The affected batches represent 0.1% of first-half sales by volume. But the market's reaction was not proportional to the recall itself. It was proportional to what the recall revealed about where the stock already stood. A2 had already cut FY 2026 guidance in April, citing supply chain disruptions. Revenue growth expectations came down from mid-double-digit to low to mid-double-digit. EBITDA margin guidance fell from 15.5 to 16% to 14 to 14.5%. Net profit is now expected to be flat or slightly below FY 2025. The recall landed on a stock already repriced lower, and the China exposure multiplied the sensitivity. Food safety headlines in infant formula carry asymmetric reputational risk in that market specifically because of the 2008 precedent. Accent Group compressed the same logic into a single session. Shares fell 14% to a 13-year low, with a guidance cut doing most of the damage. Second-half EBIT is now expected at $23 to $28 million, against prior guidance of $30 to $35 million. Management pointed to weaker consumer confidence, higher fuel prices, and geopolitical tensions as the drivers. The ASIC investigation into suspected insider trading by the CEO added a governance overhang, though no charges have been laid. What connects A2 and Accent is not sector, but mechanism. Both businesses face a consumer who has absorbed 2 rounds of rate hikes and a sustained fuel price increase, and is now deferring or substituting. For a premium infant formula brand, the substitution risk is brand erosion in export markets. For a footwear retailer running 55% gross margins, the risk is that promotional activity needed to clear inventory compounds the margin compression already underway. The question the RBA will not be asked tomorrow, but the one that matters most for both stocks, is whether the slowdown showing up in forward-looking corporate guidance represents a normal tightening cycle response or something deeper. NAB's $300 million provision is one answer. Accent's like-for-like contraction in April is another.
Two scenarios are now running in parallel, and Tuesday's RBA decision will not resolve which one is correct. It will only determine how fast they diverge. In the first scenario, the RBA hikes, inflation peaks in Q2 as the oil shock works through, and the economy absorbs the cumulative tightening without a hard break. Business lending growth, up 11.5% at NAB, with the bank still holding a 22% market share, suggests corporate Australia entered this period with genuine momentum. Consumer stress is rising, but remains localized to the most rate-sensitive and discretionary segments. NAB's CET1 ratio of 11.65%, rising to 12.05% pro forma after the partially underwritten dividend reinvestment plan, gives the bank room to absorb credit deterioration without a capital event. In the second scenario, the energy shock proves more persistent than the RBA's forecasts. Q2 CPI does not peak, and August brings a fourth hike onto a consumer sector that has already begun contracting. In that sequence, the $300 million provision NAB built in the first half is not a ceiling, it is a floor. Retail credit starts showing the stress already visible in corporate guidance, and Australia, as HSBC's Paul Bloxham noted, finds itself in the position of being the only major economy still hiking, while others hold, with all the currency and capital flow implications that entails. The verification benchmark is concrete. If Tuesday's hike is delivered with a hawkish statement that implies August is live, watch the ASX consumer discretionary sector in the following 72 hours. Accent is already at a 13-year low. The next tier, mid-cap retailers with similar exposure to discretionary traffic and fuel-sensitive supply chains, would be the first place that signal shows up. NAB CEO described the bank as well-placed to navigate a period of increased volatility. That is the language of managed uncertainty. The $300 million provision is the number behind it. If August delivers a fourth hike and CPI stays above 4%, the weight of evidence suggests that number gets revised upward, and the stocks already trading at multi-year lows have further to fall before the forward curve gives them a reason to recover. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.